What is a share buyback? Why do companies buy back their own shares? Just imagine, you've invested in the stock market and you hold shares of a well-known company. Suddenly, one day the news breaks that the very same company whose shares you own now wants to buy them back from you. The first question that pops into your mind is, wait, why would a company want to purchase its own shares? Is there some hidden reason behind this? Or is this a signal of big profits for us? It almost sounds like a mystery. But in reality, this is the world of share buybacks, where companies repurchase their own shares to send different signals to the market and investors. It's not just a financial process, it's a game of trust and strategy. Recently, India's second-largest IT company, Infosys, created a buzz in the market by announcing its biggest-ever share buyback offer. The date was September 12. As soon as the announcement came, investors and analysts locked their eyes on Infosys. Everyone began asking, why would such a massive company want to buy back its own shares? Some saw it as a sign of confidence, while others thought perhaps the company had such huge cash reserves that instead of spending it elsewhere, it chose to use it for a buyback. Even retail investors grew curious. Would this bring them direct benefits? Or was it just a clever corporate move? Today, we'll dive deep into this topic. But before that, if you're new to our channel, don't forget to subscribe so that you're the first to receive updates on all our latest videos. So, without any delay, let's begin today's discussion. First, let's understand what a buyback really is. Imagine this. You once created a priceless piece of art that later got sold at an auction. But a few years down the line, you realize that the artwork is far more valuable than the price it was sold for. Naturally, you want to buy it back, right? A share buyback works exactly the same way. The company feels that its shares are currently undervalued in the market, and since they are worth more, it decides to buy them back. It's a company's way of showing confidence in its own strength. There are two methods of share buyback. First, buying directly from the open market. In this case, the company goes into the stock market and purchases its own shares. Second, the tender offer. Here, the company announces a fixed period during which it invites investors to sell their shares back. Usually, the company offers a price higher than the current market price. This directly benefits investors because if you sell your shares through the buyback offer, you may get more money than the stock's market price. Now the question is, why does a company feel the need to buy back its own shares? There are several important reasons. Reason 1, excess cash reserves. Sometimes, companies like Infosys generate so much revenue that they end up with thousands of crores lying idle. But if they don't have any profitable projects to invest in at that moment, they use buybacks as a way to utilize that money effectively and keep investors happy. Reason 2, tax benefits. In India, when companies pay dividends to investors, multiple layers of tax apply, both on the company and the investor. But in the case of buybacks, the overall tax burden is relatively lower. This makes buybacks a more tax-efficient way of rewarding investors. That's why many large companies prefer share buybacks over paying dividends. The third reason, a company wants to maintain control. Think about it. If a company has too many small investors, every decision can become a debate, sometimes making it difficult to take big calls. In such cases, by buying back its own shares, the company reduces the total number of shares available in the market. This strengthens the board's voting power and helps the company retain better control over its decisions. The fourth reason, the company feels its shares are undervalued. In other words, the market isn't recognizing its true worth. For example, if a company's actual value is 2,000 rupees per share, but it's currently trading at only 1,500 rupees, the company may initiate a buyback. This sends a strong message to the market that the company believes in its future and expects its shares to rise in value. The fifth reason, to reward investors. Just like companies distribute dividends to keep investors happy, Buybacks are another way of doing the same. When a company buys back its shares, the demand for those shares increases, which often pushes the share price upward. This benefits investors not just immediately but also in the long run. Now let's talk about the impact of share buybacks. The biggest impact is on EPS, earnings per share. When a company reduces the number of outstanding shares, its profits are divided among fewer shares. As a result, the EPS rises. For investors, this is a positive signal because higher EPS means the company is earning more per share. The second impact is on the balance sheet. After a buyback, the company's cash reserves go down, since that money is used to repurchase shares. This reduces the company's total assets and shareholders' equity also declines. But here's the interesting part. Ratios like ROE, return on equity, and ROA, return on assets, often look stronger after a buyback. That's why companies sometimes use buybacks simply to make their financial position appear healthier. A share buyback also affects the company's image. When a company buys back its own shares, it signals confidence in its future. For investors, this is a very positive message. That's why in many cases, as soon as a buyback is announced, the company's stock price rises. If we look at history, companies like Infosys, TCS, Wipro, and HCL Technologies in India have carried out buybacks multiple times. In 2017, TCS executed a buyback worth around 16,000 crore. In the US, companies like Apple and Microsoft have carried out buybacks worth billions of dollars. In fact, Apple announced a $90 billion buyback program in 2022, making it one of the largest buyback announcements ever. These examples clearly show that buybacks are not limited to Indian companies, they're a global strategy. But there's also a warning for investors. A buyback is not always a positive signal. Sometimes companies use it simply to stop their falling stock prices in an attempt to preserve investor confidence. It can also be a psychological play. When people see that a company is buying back its own shares, they assume the company must have some big plan ahead. Maybe a new product launch, an acquisition, or an aggressive business expansion. So what should the average investor do? If you already own shares of the company, a buyback offer can be a chance for quick profit, since you'll likely be offered a higher price than the market value. But if you're a long-term investor, you may decide not to sell. After all, if the company itself believes it's strong, its shares could be worth even more in the future. Share buybacks also teach us that a company's true strength lies not only in its products, but also in its financial decisions. When companies like Infosys announce buybacks, it's not just about spending money. It's a declaration of confidence in their own future. That's why the next time you hear about a company doing a buyback, don't see it as just a transaction. See it as a statement of confidence, a signal of future plans, and a potential opportunity to improve your own investment strategy.
If this video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.